Hey, it's Nathan with OptionsForL.com. In this video, I'm going to show you how I lost $5,000 on an early assignment for a short put option, and then I'm going to explain what happened and hopefully teach you how you can avoid a similar situation that I experienced, because it's kind of painful. All right, so first and foremost, the evidence that it happened. So I had the IBIT 6550 put option, short put option with an expiration date of October 17th. So you can see that this assignment occurred on October 16th, so the day before the option expired. You can see it was 9 contracts and $58,950 is what I had to pay for 900 shares of IBIT stock, or the IBIT ETF, and I had to pay at the 6550 price. So we can do the simple math real quick. So 6550 times 900 shares is $58,950. And of course, the issue right here was that on the market, the price of IBIT was about $60. So about $5.50 less per share than what I had to pay for it. And so 900 shares of IBIT showed up in my account, and I was not able to hold on to them for the long run because they were purchased on margin. And so I closed them out as soon as the market came open on October 17th. So you can see right here, I sold 450 shares at $60.07. I was kind of hoping that the market would kind of jump back up because it had just experienced a pretty aggressive dip. And so I was kind of holding on to the other 450 shares to see if it was going to come back up, but it started dropping. So I just went ahead and I sold the remaining 450 shares. And so you can see right here, minus 26,919 minus 27,029. $5,002 is essentially what I lost in this particular trade. And that's because the put option went deep in the money and it was the day before expiration, so there was not much time value or extrinsic value left. And so the individual that had purchased the put options from me was like, heck yes, I'll sell 900 shares of my IBIT ETF for $65.50 when the market price is around $60. And so on this day, I learned quite a bit about extrinsic value and how to monitor it and watch it, because it's a key indicator of if your options will be exercised early. Now, let me come over here and do a quick explanation. So when you short an option, so you sell an option, you sell a put, you sell a call, you sold somebody else the right, and that means you take on an obligation, and that means you have to do it. If they exercise, that means you have to do it. You do not have an option. You have to do what the option says if the buyer exercises their right on that particular option. So if you're short a call, you're obligated to sell 100 shares at the strike price if you get assigned. If you're short a put, like I was, you're obligated to buy 100 shares at that strike price. And since in my case I had 9 contracts, that wound up being 900 shares. Assignment can happen anytime for American style options, so you don't control the timing. Early assignment risk mostly shows up when the option has very little extrinsic value left. Extrinsic value is a time value premium on top of intrinsic value. If extrinsic value is near zero, the long holder doesn't lose much by exercising early, so the chance you get assigned goes up. And we're going to hop over to Robinhood and take a look at the extrinsic value. So rule of thumb, low extrinsic value equals higher early assignment risk, especially right before expiration. So like in my case, I was 1 day before expiration and I had very low extrinsic value because the put option was deep in the money. And when it comes to short and call options, you face some additional risk around dividends for those short calls. So when you're short options, you always want to check how much extrinsic value is left to gauge assignment risk. Now I'm going to go to Robinhood and take a look at some real life examples. So here we are in Robinhood. And I have this IBIT 56 put, short put right here. You can see I have 10 cells with an expiration of December 31st, so New Year's Eve. And IBIT, let me scroll down just a little bit, is hovering around $48 right now. So my $56 short put is deep in the money and is at risk of basically being early assigned. So let's go ahead and look at the extrinsic value real quick and see how much extrinsic value is left. That gives us an idea of how much risk there is. So we'll click into it, and I want to go to view all options, and let me change the expiration date to where my options actually are, so December 31st. And I'm going to switch to the put side, and we'll come up here and we can see my 10 short puts at the $56 strike price. And I'm going to calculate extrinsic value manually so you see how it works, and then I'll show you how you can have Robinhood calculate it for you. So here we go. So the share or the strike price is $56 and the share price is $48.18. And if we think about this logically, so they can sell their shares of IBIT at $56, right? The market value is 48.18. So some simple math would say 46 minus 48.18, $7.82, and that's what is considered intrinsic value. So that's what the option is actually worth, because they can sell their shares for 56 bucks when on the market they're 48.18. Now to get the extrinsic value, which is basically calculated from implied volatility and time. So the more implied volatility and time on an option, the more extrinsic value it's going to have. So looking at the ask price real quick, we can see that it's $8.95 to buy this particular put option. And let's switch to sell real quick. And we can see that it's $8.75 to sell this particular option. And usually how you calculate extrinsic value is you take the midpoint, which would be about $8.85. So that's pretty simple math right there. So let me go back to my calculator. And we'll do $8.85 minus $7.82 is $1.03. So that's basically the extra value of the option added on top of the intrinsic value that we already calculated. And that is extrinsic value. And so there's a fair amount of extrinsic value still sitting on this option, and my likelihood of it being exercised is quite low, even though it is deep in the money. Now as time progresses and it gets closer and closer to the expiration date, that extrinsic value is gonna go down to zero. And the closer it gets to zero, the greater my chance of the option being exercised. And so it's something that I need to monitor, and maybe when it gets lower and lower, at a certain point, I need to make the decision to roll my option down and out, or maybe just get out of it and cut my losses. Now I'm gonna hop over to Robinhood Legend real quick because it calculates the intrinsic value for you, and that just makes it a little easier. I just wanted to explain like how it's calculated so that way you can understand it. And if you think about it, it makes sense how to calculate it. So here I am in Robinhood Legend, and let me switch over to IBIT. So we're looking at the same type of numbers. And let's go to the one I was just looking at, so December 31st. Let's open that up. And let's go ahead and go down to my options. So I'm on the put side right here, and you can see my 10 short puts at the $56 strike price. And you can see my extrinsic value right here, the $1.03 that we calculated. So that's pretty cool that the math still worked out. And you can see the column right there, extrinsic value. To add it, you just come up here, customize columns, and you can add in extrinsic value right here. You could also add intrinsic value if you want that calculated as well. But I'm primarily concerned with extrinsic value at this point in time. As you can see, the further in the money the options are, the smaller the extrinsic value is. So you can see it drops lower and lower. Now there's 39 days until expiration, so a lot of these options are gonna have some extrinsic value, but as you get closer to expiration, it drops significantly. And so let me go to a shorter expiration date. We'll go to 6 days out right here, and we'll look at the put options. Now, we can see that the extrinsic value is calculated at 23 cents. However, I do want to point out that there's no open interest or volume. So this calculation is not going to be accurate at all. You want to make sure you're looking at options that have some volume, which will be closer around to the current price of the stock. So let's come on down here, and you can see that there's a lot more volume and open interest down here as we get to the price of the stock. And the expiration date is still 6 days out for this particular one. But as it gets to the end of the week, like Thursday and definitely Friday, the extrinsic value is going to drop way down. And if your short options are in the money, you're going to be risking early assignment. So definitely when you have short options, so short calls or short puts that are in the money, you need to be monitoring that extrinsic value. The closer it gets to zero, the greater your chance of being early assigned. And it can be quite a painful experience. Like I lost $5,000, but I've heard horror stories where people have lost a lot more. So hopefully you learned something from this video, and hopefully you don't make the same mistakes as me. If you found this video helpful, I appreciate any sorts of likes, comments, subscribes, and I hope you have a great rest of the day.